Financial modeling is the process of creating mathematical representations, models, of financial situations or processes to analyze and forecast the financial performance of a business or investment opportunity. These models typically incorporate various financial variables, assumptions, and scenarios to simulate different outcomes and make informed decisions. Here's how to build financial models for scenario planning. Define the purpose. Clearly define the purpose and scope of the financial model, including the key objectives, stakeholders, and decision-making criteria. Determine the specific scenarios, assumptions, and variables to be included in the model based on the intended use and analysis requirements. Gather data and assumptions. Collect relevant historical financial data, market data, operational metrics, and other inputs needed for the model. Gather assumptions about future trends, market conditions, economic factors, industry benchmarks, and business drivers. Design the structure. Design the structure of the financial model, including the layout, organization, and flow of information. Identify the components to be included in the model, such as revenue projections, expense forecasts, cash flow statements, balance sheets, and financial ratios. Develop formulas and calculations. Develop formulas and calculations to represent the relationships between different financial variables and components. Use Excel functions and mathematical formulas to perform calculations for revenue projections, expense allocations, depreciation schedules, and other financial calculations. Build scenarios. Create multiple scenarios to simulate different outcomes and assess the impact of various factors on financial performance. Define the assumptions, variables, and constraints for each scenario, such as revenue growth rates, cost structures, pricing strategies, and market conditions. Perform sensitivity analysis. Conduct sensitivity analysis to evaluate how changes in key variables or assumptions affect the results of the financial model. Identify the most critical drivers of financial performance and assess their sensitivity to changes in market conditions, input parameters, and business strategies. Validate and review. Validate the accuracy and reliability of the financial model by comparing its outputs to historical data, industry benchmarks, expert opinions, or alternative models. Review the model for errors, inconsistencies, and logical flaws, and make necessary revisions or adjustments to improve its accuracy and usability. Document assumptions and methodology. Document the assumptions, methodologies, and sources of data used in the financial model to ensure transparency, reproducibility, and auditability. Provide clear explanations and annotations for complex calculations, formulas, and modeling techniques. Communicate results. Communicate the results of the financial model to relevant stakeholders, decision-makers, or investors in a clear, concise, and actionable manner. Present key findings, insights, and recommendations based on the scenario analysis and sensitivity testing. Update and maintain. Regularly update and maintain the financial model to reflect changes in market conditions, business strategies, or operating environments. Monitor actual performance against the model's projections and incorporate feedback or new information to improve forecasting accuracy over time. By building financial models for scenario planning, businesses can assess the potential impact of different scenarios, evaluate strategic options, and make informed decisions to navigate uncertainty and achieve their financial objectives.